Welcome to the deep dive. Today, we're unlocking a really powerful concept for navigating the financial markets. It's all about drawdown control. We're specifically looking at why it's so critical for swing traders, using a whole stack of insights you've shared.
Yeah.
Our mission really is to show you why protecting your capital is, well, just as vital as growing it, maybe even more so sometimes.
It's fascinating, isn't it? So many traders, they fixate on those big wins.
Right, the home runs.
Exactly. But what truly distinguishes, enduring profitability, it's often the discipline to protect your capital.
Okay.
So this deep dive will unpack what drawdown really means, why it's so critical, and how it profoundly impacts both your trading account and your mindset.
So let's get right into it then. We often hear about, simple losses, but our sources make a point of highlighting a distinct difference with drawdown.
Yes.
What's that core difference, and why should you, the listener, really pay close attention to this?
Well, a simple loss, that's just a decline from your purchase price.
Yeah.
Straightforward.
Okay.
A drawdown, though, that's a peak-to-trough decline. It's measured from your highest account value. It reflects the true erosion of your success, your overall progress. And the most important figure, really, for any trader is the maximum drawdown, the MDD.
MDD.
It's the worst historical decline your account has seen. It really reveals the absolute maximum pain you've had to endure, or perhaps might have to endure in the future.
And here's where I think it gets really eye-opening. Our sources talk about the asymmetrical math of recovery.
Devastating math.
It's a harsh reality, isn't it? A 50% drawdown doesn't just need like a 50% gain to recover. It needs a staggering 100% gain.
Doubling your money.
Just to break even. So what does this crushing math really mean for compounding your capital over time?
Well, it just perfectly illustrates why preventing those large losses is mathematically superior, period.
Yeah.
Imagine trying to fill a bucket that has this massive hole in it. Every large drawdown isn't just a step back. It fundamentally weakens your ability to recover and grow. Your capital base is smaller.
Makes sense.
And this is precisely why drawdown is often a more relevant measure of risk for a trader than, say, general volatility. It directly quantifies the potential magnitude of pain and its impact on your ability to compound.
Okay, so beyond just the raw numbers, our sources dive deep into the psychology of loss.
Oh, yeah. Crucial.
It's not just financial, is it? It's like a profound battle happening in your head.
Oh, boy.
And there's this distinction they make between a technical drawdown, the normal expected dips, and an emotional drawdown. That sounds like self-inflicted damage.
It often is. That emotional spiral, it frequently kicks off when a normal technical loss is taken personally, like it's a reflection on you.
And that leads to irrational decisions, I assume.
Absolutely. And what fuels this spiral? The sources identify what they call the trader's three demons.
Okay.
First, loss aversion. The studies show the pain of a loss feels roughly twice as intense as the pleasure of an equivalent gain.
Wow.
Twice. Yeah. So it leads you to hold on to losers way too long, hoping they'll come back. Then there's revenge trading.
Trying to get even with the market.
Exactly, that desperate urge. And finally, ego. Just the sheer inability to admit you were wrong on a trade. And if you step back, even biology plays a role here. High cortisol levels from stress, from losses, literally impair your rational judgment. Your brain works against making disciplined choices.
So your own body chemistry is fighting you.
In a way, yes. The only real defense,
Yeah.
a pre-committed trading plan, sticking to it no matter what.
Okay, so how do we build that resilient mindset then? How do we fight back? It starts, according to the sources, with your first line of defense.
Go away, Jess.
Cutting losses, swiftly and systematically, non-negotiable.
Absolutely fundamental.
They really emphasize defining your exit before you even enter the trade, using a stop-loss order. Specifically, they mention a stop market order for execution certainty.
Right. A stop market means when your price is hit, it becomes a market order. You get out at the next available price. You're guaranteed execution, though maybe not the exact price in fast markets.
Okay. Certainty of getting out.
Yes. And where you place that stop is crucial too. Avoid just fixed percentages, like always selling a 5% down.
Why is that?
Because it doesn't respect the stock's own behavior. Instead, tie it to chart structure, below a key support level or above resistance if you're short.
Makes sense. Tailor it to the specific trade.
Or use the average true range, the ATR. That's a measure of a stock's typical price movement, its volatility. So your stop adapts naturally.
Okay, ATR. And it all ties into risk management per trade, right?
Directly. It connects fundamentally to the 1% rule, or maybe 2% at the absolute max. Never risk more than that small percentage of your total capital on any single trade.
And that dictates your position size?
Exactly. There's a clear formula. How much you're willing to risk per trade, divided by your risk per share, the distance to your stop, tells you how many shares to buy. It ensures uniform risk across different trades, regardless of the stock price or volatility.
Okay, so we've covered defense really well, protecting capital. But what about when things go right? When a trade moves in your favor?
Good question.
Our sources highlight a powerful strategy, scaling in, which they say is very different from the dangerous practice of averaging down on losers.
Oh, night and day difference. Averaging down is adding to a losing position. Scaling in is adding to a winner.
So what's the philosophy behind scaling in?
It's about committing more capital only after the market confirms your initial trade idea. You might start with a small position.
Okay.
Then, as the price moves favorably, validating your thesis, you add incrementally. Maybe add a bit more on a breakout or after a pullback holds.
And you adjust your stop loss as you go.
Always. You trail your stop loss upwards to protect the initial capital, then protect profits, and ultimately, hopefully, move to a risk-free position where your stop is above your initial entry.
Got it. And the sources also mention scaling out.
Yes, taking partial profits as the trade progresses. Also a key part of disciplined trading. Locking in some gains.
Okay, finally, the sources give some actionable ways to maybe refine entry and exit timing, using things like candlestick patterns.
That's right. They mention patterns like the hammer. That's often a bullish reversal signal after a downtrend.
And it gives you a clear place for a stop.
Exactly. Right below the low of the hammer candle. Very defined risk. They also mention the doji, which signals indecision. It needs context, but it can flag potential turning points.
So these patterns aren't just shapes, they're like little battle plans.
In a way, yes.
Yeah.
And we can't forget momentum oscillators like the RSI, the Relative Strength Index.
Right, RSI, overbought, oversold.
Well, be careful there. Traditional overbought or oversold readings can be misleading in strong trends. A market can stay overbought for a long time in a powerful uptrend.
Okay, so what's more useful then?
RSI divergence. That could be a potent leading indicator.
Divergence, how does that work?
Okay, so regular divergence is when, say, the price makes a new higher high, but the RSI makes a lower high. It suggests the upward momentum is weakening. Could be a sign of a potential reversal.
Ah, a warning signal.
Yes. And then there's hidden divergence, which is kind of the opposite. And it signals trend continuation. It helps you stay in winning trades sometimes. Helps avoid traps and confirm moves.
Wow, okay, so this all kind of synthesizes into having a complete drawdown control system, doesn't it? A non-negotiable trading plan.
Absolutely, it has to be systematic.
And our sources even pull in wisdom from some trading legends. Paul Tudor Jones said, what, 90% of a great trader is risk control?
Something like that, yeah. Defense first. Jerry Parker advises reducing your position size twice as fast as your drawdown increases. Get smaller, faster when things go wrong.
And Richard Dennis, with the Turtles experiment, proved that enduring drawdowns, but strictly adhering to rules like never risking more than 2% per trade, was absolutely key.
Sticking to the system through thick and thin, that was the core lesson.
And zooming out, like, big picture, Charlie Munger's view reminds us that a long-term investor can, and often must, sit through 50% declines.
Right. Different game entirely.
But a swing trader, they simply cannot afford that kind of hit.
No way. It raises that important question. Why is your time horizon so critical when you think about risk?
And the answer is?
Because as a trader, your very survival, your ability to stay in the game, depends on proactive, stringent capital preservation. You don't have decades to recover from a massive hit.
So wrapping this up, what does all this really mean for you, the listener? Mastering drawdown control isn't just some tactic. It feels more like a holistic superpower.
I like that, a superpower.
It's the discipline, right? To protect your capital above all else, understanding that if you manage the downside effectively, the upside, well, it tends to take care of itself eventually.
That's the essence of it. It truly is about living to trade another day. That's the ultimate commitment, turning trading from what feels like a gamble into a managed, sustainable business.
So here's something for you to mull on. Looking at your own approach right now, what is one small, immediate action you could take, starting today or tomorrow, to implement better drawdown control? Just one thing.